You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello and welcome to The Investor Way with myself, John McEwen, and my co-host Sam Ball. This week on The Investor Way, we have YouGov, Croda, Tritax, Whitbread, Ibstock, and our most international company of the week is ASML. Sam, do you want to kick us off with YouGov?
Yes, a company which I own, unfortunately, as it has done terribly since I bought it. So YouGov have come out with their full year results, and revenue was up 16% to 388.9 million, but the underlying revenue was only up 1%, so the rest of it was from acquisitions. Adjusted operating profit was up 22% to 60.7 million, and the operating profit margin was up from 15 to 16%. Statutory operating profit was up 188% to 31.4 million. Adjusted profit before tax was up 8% to 48.8 million, and the statutory profit before tax was up 353% to 18.1 million. Adjusted basic earnings per share was up 8% to 31.7p, and the statutory earnings per share was up from negative 2p to positive 11.5p a share. Operating cash generation was up 17% to 63.3 million, and net debt was down 3% to 144 million, and the dividend was up 3%. The YouGov have said that the revenue growth reflects the full year impact of YouGov Shopper, which was formerly CPS, and the underlying revenue growth of 1% was down slightly from 3% last year as they stabilised the business during a period of organisational change and leadership transition. And the leverage ratio now stands at 1.7x net debt to EBITDA. If we look at the performance by division, data products was up 1% to 84 million, and that's out of a total of 389 million. Shopper, that's new this year, so that's 128 million out of 389 million. Research was up 1% to 177 million out of 389 million. So about half the revenues coming from research, although Shopper has added quite a decent chunk. And if we go down into a bit more detail for the divisions, for data products, they've said our subscription-based data product sites include YouGov Brand Index, YouGov Profiles, and other behavioural products such as YouGov Safe. Revenue from data products was flat on a reported basis and recorded 1% growth in underlying terms, reversing the decline seen in the prior year owing to normalised renewal rates and the new client wins in the media agency and retail sectors. Adjusted operating profit from data products was 25.8 million, resulting in a slight contraction of the adjusted operating margin to 31%, down from 33%. This was due to the loss contribution from the Yabble acquisition of 3.3 million. For the Shopper division, they've said that this division provides household purchase data across 17 European countries. In the first full year, it's contributed an operating profit margin of 21%. The better than expected profitability is in part due to accelerated delivery to clients in July and a delayed start to investment in new growth initiatives. These investments, which are expected to accelerate top-line growth in the coming years, have commenced in Q4 25 and are expected to temporarily impact margins in the 2026 financial year. For the research division, they've said this comprises their fast turnaround research services, such as YouGov Real-Time Omnibus, as well as customised research projects and multi-year tracking studies. Revenue in the research division remained stable on a reported basis and delivered 1% underlying growth. Good performance in the academic, technology and financial sectors was offset by lower spending from public sector and continued weakness in the gaming sector. On a regional basis, the Americas and Asia Pacific reported mid-single digit growth on an underlying basis, while Europe, Middle East and Africa remained weak. Adjusted operating profit was slightly lower than the prior year at 19.5 million, and the margin remained stable at 11%, as the benefits of the cost optimization plan were offset by lower revenue growth. And if we look at the performance by geography, so again, total revenue 389 million, the UK 70, Americas is 124, mainland Europe is 185, so about half, Asia Pacific's 29, and then there's intragroup revenues of negative 20, which is why it doesn't add up otherwise. In terms of the underlying growth, they're all pretty flat. UK grew 0%, Americas grew 3%, mainland Europe grew 0%, but it was 40% when you include acquisitions. Asia Pacific grew 2%. You may recall when we went through the P&L, there was a huge difference between the earnings and the adjusted earnings. They have said, the adjusted earnings per share has been calculated to reflect the underlying profitability of the business by excluding share-based payments and related employer social tax costs, imputed interest, impairment charges, other separately reported items, and any tax effect, blah, blah, blah. Share-based payments and related social taxes have been excluded from the adjusted earnings per share, as the YouGov share price is a key driver of these costs. The share price varies for many reasons, so is not directly impacted by management. I really, really don't like this, especially as a shareholder. I think share-based compensation is very much a cost for the shareholders. Just because the management don't directly control the share price does not mean that it's not a cost for the shareholders. So why you would strip it out is absolutely beyond me. I honestly think it's ridiculous. This is very much a company that is in the naughty pile for me anyway, because it's not really done anything since I bought it other than go down for the past 12 months. This is a very big no-no, that statement. I really, really can't get across enough how strongly I dislike it. So in terms of valuation, if you use their adjusted earnings, which I would strongly suggest you do not do, you get a PE ratio of 8. However, if you use the actual earnings, you would get 23. So there's a huge difference there. And the dividend yield is 3.6%. I think these results are pretty disappointing. If you strip out the acquisitions, the company's not really done anything, and this is a company that should be growing. But for me, the biggest turn off it is that treatment of the share-based compensation. John, as someone who's a bit less biased, what do you think of the results and the company?
Yeah, I think in terms of what management are doing, I would be worried as, I suppose, a culture within the company. And yeah, I mean, I can't get excited about these results. I suppose it was putting it back to you as a shareholder. Are there any positives that you're taking from it? I know there are, those concerning points that you mentioned. And is there anything that you see driving the business forward?
I think the shopping division looks interesting, and hopefully that's still actually going to be growing, because it doesn't look like the rest of it is. But the shopper looks like a good acquisition. I think using the shopping data, it fits in quite nicely with the rest of the business, and hopefully that should be quite a smart acquisition. So I think the shopping is, although they bought the Grove, at least it does look like a smart acquisition.
Okay, fair enough. I can say I don't think it's one for me, but I think, interesting, and I did think it was probably more interesting the first time we covered it, and perhaps now I'll just be watching from the sidelines. But
I wish
anyway,
I'd taken that view.
well, there are a few I've taken that view on, and I live with regret. So anyway, let's move on to Croda. So Croda, I think we have covered it before, but for anyone who doesn't know, it supplies the ingredients for industrial applications, the life sciences, and consumer care brands. It's a relatively small player in the chemicals sector, but anyway, we'll go on to their third quarter results out that they had last week. Third quarter sales grew by 6.5% to £425 million against the 5.9% expected when ignoring currency movements. Growth was led by the consumer care business, which saw a rebound in beauty activities, a rebound in beauty actives, and strong double-digit gains in flavours and fragrances. In life sciences, a continued recovery in crop protection more than offset a weakness in sales to the pharmaceutical customers. All regions contributed positively to sales growth, except Asia, where US tariffs weighed on performance. Full-year pre-tax profit guidance, it comes in at between £265 and £295 million, which is unchanged. And the shares were up nearly 4% in early trading. In terms of valuation, the group has a market cap of £4.1 billion and trades at 16.9 times forward earnings, compared with a 10-year average of 25.2, and it has a prospective dividend yield of 4.3%. I thought these results were pretty good. Not a company that I would get especially excited by, although it does seem to be, reasonably well diversified, and it's got some fairly niche sectors in there too. So probably not one for me in terms of investing. However, I think it's possibly one that we may cover a little bit more in the future and dig out potentially those niches and just see whether there's a little bit more of an investment case there. I don't think a bad set of results at all. Sam, what are your thoughts?
I think the results are pretty decent. I think the valuation looks pretty reasonable. I think for that growth rate, forward P of 17 over 4% yield, I don't think that's bad at all. it does look like it's potentially a high quality business, but I need to understand more about what it does. Because I think in terms of the products, they're quite hard to kind of visualize because they're maybe not things that you're actually seeing day to day. So I'd probably, like you, I'd probably need to drill down a bit more on the individual segments. But on the surface, it looks like a fairly decent business.
Yeah. And it's not that sort of Peter Lynch company where you go and look in the shop and you see whether people are queuing out to the door. Maybe it's one where you go into the shop and you look at the bottle of perfume or something and you find it there. But no, I think it does need some more research, but potentially an interesting one.
Agreed. Should we move on to one that we've covered quite a bit recently?
Oh yes, and I drive past one every day. How are Tritax doing?
So again, still no results, but we've covered the latest set of results recently. We then covered the warehouse REIT deal, which was called OFF. So if anyone is not familiar, Tritax is a pure play logistics REIT. So they were going to buy warehouse REIT, which looked like it had a lot of complementary properties, or merger of it, whichever one it was. However, they were outbid by Blackstone, which we covered a few weeks ago. We don't have a huge issue with. If they don't think the price is right, we're quite happy for them not to overpay. Not that either of us are shareholders, but it's a REIT that both of us, I think, like quite a lot. So they have now announced that they are acquiring a £1.04 billion logistics portfolio from Blackstone. So Blackstone, the ones who outbid them on warehouse REITs, presumably they now need to fund warehouse REIT somehow, so they're flogging some properties to Tritax, who was the second place bidder for warehouse. So it's a 1.04 billion portfolio, and it's been purchased for cash and shares. So Blackstone will become a 9% shareholder in Tritax, but the shares, interestingly, have actually been issued at a 13.5% premium to the share price at the time of the deal, which I think is pretty good, actually. Firstly, because it shows that Blackstone obviously think the value of the properties is probably higher than the current share price, which I guess isn't a surprise given it is currently at a 25% discount to the net asset value. So I suppose that confirms that actually the net asset value is maybe more likely to be fairly accurate. They are acquiring a portfolio of logistics assets, and they've said the consideration is made up of £632 million in cash, which will be funded via a new £650 million debt facility, and up to £375 million of new ordinary shares, which, as mentioned, are being issued at a premium. So they're being issued at a price of 161p a share. That actually compares to a current share price of 148p a share. And they said the acquisition adds a high-quality, well-located urban logistics weighted portfolio of scale with rental reversion potential of about 28%. The shorter-dated last mile and urban leases provide an accelerated pathway to capturing the significant rental reversion and are complemented by modern, high-specification big box assets generating significant and resilient income. Replacement costs of the assets within the acquisition portfolio exceeds the acquisition price, ensuring an attractive entry point, particularly within key urban locations where the development of new assets is structurally constrained. The assets within the portfolio have an average passing rent of £8.23 per square foot, offering the opportunity for income growth while remaining affordable to clients. And this allows Tritax to expand their urban footprint across key micro locations in the Southeast and the Midlands. And they've said that shifting demographics have reduced logistics space in UK cities, severely constrained new supply, and decreased options for occupiers. So some long-term tailwinds there. The acquisition is expected to be mid-single-digit earnings per share accretive in the first full year post-acquisition and meaningfully accretive thereafter. And again, that's not bad at all, considering share price currently 149p. So if you're adding mid-single digits earnings per share, that's a good few percent there. And the acquisition enhances Tritax's position as the UK's leading listed logistics pure play platform, with a portfolio value of 7.9 billion now. In terms of the valuation, Tritax currently has a dividend yield of 5.15% and trades at a discount to the net asset value of 24.5%. I think this is a good deal. I like it. I like to think that because Tritax missed out on that warehouse REIT, that they may have been able to get quite a good price from Blackstone, given they maybe might not otherwise have been on the best of terms. The fact that Blackstone are paying a premium for the shares, I think, suggests that may be the case. And I think it looks like a smart acquisition. It looks like the properties will fit in well. I really, really like Tritax. Operationally, I've not really got any complaints about it. In terms of the discounts net asset value, not really got any complaints. My only issue would be that dividend yield's just over 5%, but I think we are seeing opportunities to get kind of 6% plus from some of the very high quality REITs. So my concern would just be the opportunity cost. There might be an argument that maybe some of that earnings per share that's going to come from the Blackstone acquisition, if you factor that in and assume that's going to be paid out as a dividend, which most of it will have to be once the debt's been serviced because of the REIT status, that it might actually be a slightly better forward yield. But yeah, my concern is you can just get a better yield elsewhere. But I really like Tritax. John, what do you think of this deal and Tritax?
Yeah, I mean, very similar. I think it's very well run and it sounds like a good deal. So if you looked at the full or the future earnings, you would expect, assuming it proves to be a good deal, for that to come through to you as a shareholder. I suppose the reason that I haven't bought shares in it is that it was up there on my watch list, and I actually went ahead and bought shares in Supermarket Income REIT and Primary Health Properties. So two other REITs, which I think are, well, in my opinion, just pipped it. Possibly that was on valuation grounds, although I still think Tritax is very, very good. I'm quite happy with my REITs. Would I be happy with Tritax in my portfolio? Absolutely. Do I need another REIT at the moment? Probably not. So that's largely why I'm sort of sitting on the fence with Tritax.
Should we move on to Whitbread then?
Yes. So Whitbread, I don't know whether it's becoming a favourite of the show, although neither of us own Whitbread. For reference, Whitbread, I mean, it's a company that has owned just about everything in the 150 years that it's been in existence. At the moment, it is just basically the Premier Inn. The other big company that it used to own was Costa, which it sold to Coca-Cola 5 or 6 years ago. Anyway, where we are at the moment with Whitbread is had a difficult COVID, as you might imagine, with fewer people travelling and that hitting the Premier Inn, but it has returned to growth, and the growth story largely with Premier Inn is in Germany. So the thing with the German market is that it is very fragmented and there hasn't been a huge amount of consolidation with big players like there has been in the UK with Travelodge and Premier Inn. So that's basically the growth case for it, or the investment case for it. In terms of the most recent results, they had the half-year results out last week with first half revenue falling by 2% to £1.5 billion, with the decline led by the UK food and beverage sales. The key UK accommodation division was flat, with average room rates up and occupancy down. The drop in revenue and the increased finance charges saw underlying pre-tax profit fall 7% to around £300 million, and free cash flow fell from around £300 million to around £200 million, reflecting an increase in capital expenditure. Underlying net debt, including lease liabilities, rose from £2.9 to £3.3 billion due to the addition of new hotel leases and further share buybacks. Trading momentum into the second half is positive. However, full-year profit guidance in the fledgling German operation has been lowered, and UK cost inflation is trending higher than previously expected. The interim dividend of 36.4p was unchanged, and the shares were down around 8% in early trading. Trades at 1.63 price to book and has a market cap of £5.4 billion, and if we compare it with a historic 10-year average in terms of the forward price to book, that was 1.78, so it is trading below its average, and its prospective dividend yield is currently 3.3%. I thought these results were disappointing. I think seeing things slow in the UK and occupancy rates drop is certainly concerning. I think if you are planning on growth and future growth in Germany, you still need to have the solid UK market. So I think that is a big concern. I don't think you can blame the whole thing on the budget, but I think there are elements to that when they are a low-cost operator with the national insurance changes and potentially, I guess, the UK economy slowing down, particularly where Premier Inn is situated in that. And then the net debt increasing and the needing to be increased spend, capital expenditure, obviously not helping things. Towards the end of the period, it's looking like there are signs of hope there, but I am concerned about it. I think going forward, you'd really want to see that solid UK business maintaining things and certainly not dropping occupancy. I appreciate that to some degree they've tried to offset it with the higher room rates, but it's not something that can be, that's not a sustainable fix for it longer term. And really, you need to see Germany picking back up. So yeah, I wouldn't say I was on the verge of ever buying Whitbread shares, but certainly now I would be taking a step back. Sam, what are your thoughts on these results and Whitbread?
I don't think the results were amazing. However, I suppose not a glimmer of hope, because this is hardly all doom and gloom, but Germany grew 9%. That's not as good as we've seen historically from Germany, but they're still gaining market share. And they are still, to a degree, kind of dependent on what the broader market does, because they can outperform it, but they still need probably a buoyant hotel market, similar to how they do in the UK. I think although the German growth is exciting and does have a lot of potential, it is still a cyclical industry, and maybe a reminder of why we don't like hotels, because it's high cost to operate them and you need a certain level of occupancy to make it viable. And if you get a bad economy and the occupancy drops, that can have a huge impact on profits because your fixed costs are huge. Now, I think the German strategy is still the right one. We've talked about that before. In terms of the German strategy, they're hoping to add 70 million of adjusted pre-tax profit by 2030. Just for context, the highest operating profit in the last 5 years was 551 million. So that would be a significant addition. And that's just by 2030. You'd go beyond that, and I don't really see any reason why that couldn't continue to grow, because that's with a target of 20,000 rooms, which I don't think is actually huge. So I think there'd still be a lot of scope for growth then. So yeah, I think it's not a great set of results, but it is still a cyclical industry. I think it's just, yeah, for me, I just would have serious concerns in that industry. So I think it would need to significantly re-rate for me to even consider it. But I suppose it's proven itself to be a better business than I maybe thought it was 5 years ago, because at least I would consider it at a certain level.
Onto a business that you owned a number of years ago, Ibstock.
Yes, Ibstock. Again, this is actually another one that we have already covered recently. So we covered the latest set of results, I think, fairly recently.
Yeah.
So Ibstock have come out with a profit warning. So I'll just go straight to the trading statement. Clay and concrete revenues have been weaker than expected in the third quarter, driven by an uncertain near-term economic and political backdrop, which has weighed on customer demand. Net debt is now expected to be above previous group guidance, which had pointed to a modest increase over the prior level of 122 million. Due to the softer market demand, sales volumes in the second half of the year are now expected to be in line with the first half. As a result, full-year operating cash profit guidance has been downgraded from between 77 to 82 million to around 72 million. The shares fell 7% following the announcement. A huge issue that Ibstock has. So it's the UK's largest brick maker. However, despite the economies of scale that Go being the largest, it has struggled in recent years because of the cost of living crisis, because of energy prices, and it's because those kilns that they use to make the bricks, they need a lot of energy to get the heat up. They have trimmed the dividend payments, but yeah, in terms of valuation, now trades at a forward P of 13.2, and that compares to a 10-year average of 13. Normally, when earnings are down like this and you've got a bit of a blip, it doesn't always work very well, but I like to try and take what you think the normalized earnings are if they can get back to how they were and compare that to the current market cap to give it effectively normalized PE ratio. I think with Ibstock, there's no point. There's not really, I don't think, anything on the horizon that suggests energy costs are going to go down in the next few years. And if anything, they might still go up. But I think from Ibstock's point of view, I think if you're considering buying it, I would assume energy costs are going to stay the same until at least 2029. I don't think there's any point trying to normalize the PE ratio. I think these reduced earnings might actually be the normal level now. In terms of the yield, that's got a prospective yield of 4%, and that compares to a 10-year average of 4.4%. So yeah, it's a bit of a shame because obviously we covered the results quite recently. I do question how things have changed so drastically in such a short space of time that they maybe couldn't have included this in the results, but I guess they were maybe hoping things would pick up a bit. But yeah, disappointing to see, but they are just totally at the mercy of energy costs, and they are unfortunately operating in the country with Europe's highest energy prices. So I think until that changes, I just don't think it's an attractive investment. I think it's interesting as well because if they're not making the bricks, you do question how that impacts on the house builders because they are the main customers. So yeah, there's not a huge amount Ibstock can do, I think, but it's just also a bit concerning in terms of what it says about the wider economy, I think. What do you think, John?
Yeah, no, I think it's concerning. And I think certainly if you have the current UK energy policy, it makes it incredibly difficult for Ibstock. And I suppose even with bricks being as heavy and expensive to transport as they are, you do wonder about where the UK bricks are going to come from for the houses. And I guess as well, it is tied to the housing sector to a large degree. And if there is a wider slowdown, if the changes to planning regs don't relax as we've been promised that they will, how that's going to impact on Ibstock too. So it sounds a bit bleak, and I wouldn't say that Ibstock is cheap enough to make it look like a value play in that sense. I appreciate, these things are cyclical, but I don't think there's a huge amount to say that's really positive about it.
Yeah, and I think as well, though it might be cyclical, it's the same cycle as a house builders. So if you can get a pure play house builder and not be as dependent on energy prices, I think that's looking a lot more attractive now.
Yeah.
Whereas Ibstock, it used to look like almost like a lower risk play on the housing market, and that's just totally different now.
Yeah. But is that it's being more exposed to the energy cost, which is the real difficulty. And I mean, it depends a lot on policy. If the change, if there were a radical change in policy, and there was sort of a drill baby drill, you might see Ibstock do tremendously well from that. But then again, you would need the demand too from the sector. And so it's I think a lot of things have to go right for it to do well.
Should we move on to a business where a lot of things are going right for it?
Yeah, no, absolutely. And I think this is the highest quality business of the week by some considerable distance. We have covered it before. It's ASML. So it essentially makes the lithography machines for semiconductors. So when we talk about AI, when we talk about smartphones, essentially ASML is probably involved in that. And it almost has a monopoly on the sector. So it's an incredibly high quality business, and it's been putting up tremendous results. In terms of its size, it's the largest or second largest company in Europe. I'll have to double check on the market cap, but it's absolutely massive. They had their third quarter results out last week, with third quarter revenue up 1% to 7.5 billion euros against 7.8 billion euros expected. Operating income rose by 1% to 2.5 billion euros, which was in line with expectations, with a margin of 32.8%. New orders of 5.4 billion euros were better than expected. Free cash flow fell 54% to 244 million euros, and there was a net cash position on the balance sheet of 2.4 billion euros. Management expects fourth quarter revenue to land between 9.2 and 9.8 billion euros, and for operating income to come in at around 3.4 billion, and analysts have been expecting 9.4 and 3.2 respectively. Revenue for 2026 is no longer expected to drop from the 2025 levels, and an interim dividend of 1.6 euros a share was announced, which is payable in November. And the shares were up around 3% in early trading. In terms of valuation, the group have a market cap of 345 billion euros, and they trade at 33.9 times forward earnings with a 10-year average of 30. I think we're used to incredibly good results, and over the last year, they have been phenomenal. I think this was pretty good, and as I say, it's on the back of, well, who knows whether it's peak AI, but AI fever. So I think this is very solid. I would be pretty bullish on ASML going forward. I guess the market is generally pretty bullish too, which gives its pretty toppy valuation, but it does have a near monopoly on the sector. And if things were to slow down, or if there were to be a correction in the overall market based on AI and its applications, then you could see a fairly sharp drop in ASML. But I think for the long term, it would be a good one, and I'd be perfectly happy holding it in my portfolio. I'm sure, and I haven't worked out the percentage, that I have an exposure in the trackers that I have. I haven't been brave enough to pay up with the current toppy valuation, but I think what a business. Sam, what are your thoughts on ASML?
Yeah, I think on the surface, the results aren't amazing, but like you say, when you look at what's been going on with tariffs, we've not been able to sell into China. They've had a bit of a wobble as a result of that, but the business hasn't dropped despite those challenges. And I think investors are looking at that and they're expecting them in 6 to 12 months to get back to the growth rates that we were used to seeing the last couple of years. I think investors are probably right, but I just wouldn't be comfortable paying 34 times earnings for a business of this size with these challenges. And it's just one of them businesses where it's a fantastic business, but I feel like everything needs to go right for it to justify that valuation. Now, a lot of time with businesses like that, they do keep putting up the numbers, but yeah, I just wouldn't be comfortable buying it at that valuation, but undoubtedly the best business of the week.
So on that then, what would be your top pick and what would come last?
So I think top pick is tricky actually because of that ASML valuation. I think I'd probably go Tritax, but I wouldn't be buying it personally at the current yield. Bottom, I think I'd have to go Ibstock. I think in the current environment, it's borderline uninvestable actually. I think, which is good because it saves me the embarrassment of giving my own stock YouGov as bottom pick. What about you?
Yeah, I mean ASML. I think by far and away the most or the highest quality company of the list. I would be a little bit nervous just going out and buying it. I think in the tracker, I feel slightly more protected, but fantastic. And if I were to go out and with my own money tomorrow, I would probably go for Tritax. And last, I think it would have. Well, in fact, it would have to be Ibstock. I'd probably rather take a punt on YouGov, to be honest, than Ibstock at the moment. I think the market is just against it, and it's a really difficult one for it.
I think that's everything in that case.
Thank you very much for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.